Again, good afternoon, everybody. Thank you all for coming. I personally, in my spot, really like to do budgeting. I realize a lot of people don't, but budgeting for me is setting up a good plan and trying to set myself up for success, which is what we hope to be doing for all of our associations. So thank you all for taking the time. I will jump right in. My first slide here is what is a budget? And I realize that many of you are here because you're actually interested in this. And so some of this may be redundant, but I think it's important to talk about. The budget is a vital tool for any association. And number one, it's a fiduciary requirement in your bylaws. All bylaws require a board to set up a budget. So it's one of your board responsibilities. It helps guide your financial decisions during the year. Can we afford this? Can we not afford this? Was this in our budget? Do we need to budget for it next year? When you're making those kind of decisions, it's good to have a guideline to help you give some limits to what you're doing. Helps the board decide on priorities. Obviously, if we all had unending resources, we would do a lot. We don't have unending resources. None of us do. So therefore, you have to prioritize, and doing a budget can help lead the board to have these kind of discussions. It helps you measure the association's financial performance during the year, provides for long-term savings, also known as reserves, which is also required by your bylaws. So again, the budget helps fulfill your fiduciary responsibility to be setting aside reserves for your association for the long term. It sets the assessment levels for the upcoming fiscal year and also gives owners a nice transparent view into the association's operations. If owners want to take the time to review their budget and see the budget of the association, they can see where you're spending your money. We all know that armchair quarterbacks who want to come in at the last minute and have never read a budget, never look at the budget and claim you're spending money incorrectly doesn't do any good. If all owners paid attention and looked at the budget and tried to understand it, probably would help some of our associations run a lot better. So all these reasons, a budget is a vital tool for the association and a requirement for boards to do. So what's included in a budget? Our budgets break down to about 7 main areas. The first area is administrative expenses. And so that covers things like legal, accounting, management fees, administrative costs, and all those kind of things. The things it takes to, what I would call kind of keep the glue together, but keep things running in the association. Maintenance and repairs. So that's everything from general repairs, supplies, could be plumbing, HVAC repairs, elevator repairs, all the repairs you need to do. This is often an area where boards will under budget. And so I would always encourage you to make sure you're doing a reasonable amount of maintenance and repairs. In particular, in your budget, you're going to have a view for past years. If every year you're spending $15,000 on maintenance and repairs, don't budget $5,000 because wishful thinking is probably not going to happen. So be realistic on your maintenance and repair costs. Your contracts, so that's janitorial, landscaping. This is actually supposed to be elevators. So these are things that that you have written contracts to administer, and you generally know the amount that you're going to be spending on your contracts. The one item that's in the contract section that is not knowable is, of course, snow removal. Utilities, electricity, gas, water, and sewer. Staffing, not all buildings have staffing, but if you do, then this is going to be a section in your budget. Insurance and taxes, that's your property insurance and any income taxes you may need to be paying. And then, of course, your reserve contribution. This is saving for capital projects. And again, this is one of the things that's required by the bylaws is for the board to save. So those are the 7 main areas that these break down into. And then, of course, inside each one, you have separate line items that are going to make it up. And that's what the board and your manager need to be working on to make sure you have the adequate amounts built into each of those areas. So 7 main areas. Utilities is always a big part of this. And so, utilities are highly regulated, but they do have increases that are built in. The regulatory bodies do approve increases. And right now, for almost all of our utilities, you have some increases that have been built in for gas, water, and electricity. If any of you have ever been on a budget meeting with me, you know, I talk a lot about water. Water is going to keep going up because of the federally mandated items that they had to do and improvements they had to make about taking rainwater and cleaning it before it gets dumped into the Potomac. You know, they've had to put in massive infrastructure development, and that has to be paid for by the users. And so, you know, DC Water has increases built in for the next 5 or 10 years. And the same thing happens for electricity and gas, that they have increases that have already been approved. So you're going to see some increases in these areas. Yeah.
A quick question that came from the floor. Is there a place on the EJF website where I can see all my ongoing contracts for my association? And do you want me to take that? I mean, that's kind of an IT ops question. So
no, the answer is, and Mary, you can correct me if I'm wrong, but the answer is you have a contracts folder, and all of your contracts should be in that folder. If they're not, then you should ask your manager to make sure they put all contracts in the folder so you have visibility into them.
That's correct. And Frank, to your question, if you don't know where in the portal that is, it's under the documents section for all board members. There should be a contracts folder that you can review. And as Sam said, if your ongoing contracts aren't there, contact your manager about making sure you get those uploaded. So thanks, Sam. Sorry to interrupt.
No problem at all. Great question. I do talk a little bit here about ways to try and manage utility consumption and pricing. So the first one is you do have an opportunity for gas and electricity in DC and Virginia. I don't think you have this opportunity in Maryland, but you can choose a different supplier. So again, for electricity, your bill breaks down into 3 sections. One of them is supply, and the same for gas. And so you can choose to contract with a different supplier and lock in some prices for 1, 2, or 3 years. And oftentimes you can achieve some savings that way. This is important as I try and tell boards when I'm working with them, your job is not to play the market. Your job is to create stability for your association. So if you can lock in a supply price that's going to be a stable price for you for the next 3 years, yes, you run some risk that the prices could go down and you'll be paying more. But you're also mitigating the risk if prices go up and you're not paying more because you have a set contract. My experience in general, after doing this for more time than I wish to actually admit to, is that having these contracts generally works out in your favor. And again, it creates stability for you to be able to predict what your utility prices are going to be, and therefore you can do better budgets.
And Sam, to be clear, I believe that EJF negotiates on behalf of our clients for these third parties for the most part, leveraging the power of our portfolio to drive savings.
Yes, we do have opportunities to do that. We look for that, and we do it for the boards. You can also monitor and address consumption. You know, all bills do have consumption figures on there, and it's helpful sometimes to understand the consumption for your property, especially about water. Watch it. Is it going up or down? And making sure if it's going up, why is it going up? Do we have more people in the building, or do we have a leak somewhere? And just paying attention to those things. You can also install cost saving measures such as VFDs, which is variable frequency drives, which if you have a building that has HVAC units or other types of generators that are operating 24 hours a day, you can use VFDs to monitor how much energy you're using and cost the amount of consumption. You can also use low use shower heads and other ideas. You can talk to your manager about this, but that's one way you can get your community involved in being aware of and saving on consumption, which obviously helps limit your price increases.
Hey, Sam, off the top of your head, do you know the WSSC increase for Maryland for the year?
Not for Maryland. I do not know it off the top of my head.
Okay. Doug, I'll see if I can find that while we're talking. So
okay.
Go ahead, Sam.
Across the board, we're going to be building in 4% increases for all utilities. So that's just the way we're going to build the budgets is, you know, we see these amounts that are going up and we're anticipating about a 4% increase. All right. There also will be industry increases. So obviously today, the front page of the paper was good news. Inflation seems to be coming down, but it is not non-existent. Inflation still exists. It's still running, I think it was 2.9% as of this morning, which is just the latest. You know, early this year, it was over 3%. Now it's down to about 2.9%. Inflation goes up and down. Obviously, the government is spending a lot of time and effort A lot of politicians talking about this to try and drive inflation down. But any of you who live in the real world, which is everybody, and been to the grocery store, you know that prices have gone up. You also have minimum wage increases in DC that are driving prices up. Every year, minimum wage is going to increase in DC some amount, and that has to be passed on to the contractors who have to pass it on to the people they're paying, and therefore they're going to have to raise their prices in order to cover those costs. So all associations are going to be subjected to some type of inflationary pressures driven by sometimes federal or national, factors, sometimes driven by more local factors, but you're going to have inflation. And so we strive to make the budgets as accurate as possible. And we try and get vendors to give us pricing for 2025 now. Vendors are not always prepared to do that early on. Sometimes they don't do it until January 1st. But if we can, we're trying to get those pricings now so that we can build a very accurate budget. So anyway, just letting you know that it's not realistic if you have owners who think that their condo fees are never going to go up, because inflationary pressures are real. And the boards, your job is to do, again, set a budget that covers all of your costs. And so you should be looking at that and making sure that you're doing that in your budgets. For EJF, we are going to be capping our management fee increase at 3% for 2025. When I looked at the 12-month trailing CPI, it was about 3.5%, excluding gas and food, but we've settled on 3% for next year.
Real quick, Sam, looking online, the WSSC 2025 budget proposed a 12.1% increase overall to their budget, but I'm not seeing anything that has the approved number for WSSC yet, but we'll keep on that for you guys.
Right. The other thing you also you have to really be careful on is that, they give those numbers and they're very, very kind of general numbers, but water fees are not the same for everybody. Depends on whether you're residential, depends on whether you're commercial, depends on what level of water you use. So it sometimes takes a lot of interpretation. But I mean, if we really think Maryland is going to increase by 12%, then obviously for our Maryland properties, we should be adjusting that number up from 4% and making it a larger increase. So thanks.
Sam, there was a question in the chat I want to answer. WSSC is Washington Suburban Sanitary Commission, and they govern the water in the Maryland suburbs. So this pertains to our Maryland clients. Is that question?
Just to go back earlier, I referenced water and these federally mandated projects that had to be done. That it was DC Water. So DC Water obviously is the company inside the DC lines, and those federally mandated projects are projects that they've done over the last, I guess, about 10 years, but they were billions and billions of dollars to, again, help clean up the Potomac and the Chesapeake. So on the bright side, they're doing a lot to not dump polluted waters into those bodies of water and clean those up. On the bad side, they have to be paid for by ratepayers, which includes our associations. All right, so that's about how we're building budgets and some things, and here's our actual budget schedule. So we are trying to push out budgets earlier and earlier so that we can make sure they get in the hands of boards so they can be approved on time and make sure that we get approved budgets and new fees set up for January the 1st. Let me address one thing. Sometimes boards will respond and say, well, we can't do a budget in August or September. That's too early. Let me just say, I have to respectfully disagree. We look at 3 years of data to do your budget, including, and then plus the current fiscal year. In most cases, the operations of an association are fairly consistent year to year. And so it doesn't matter that you haven't completed this fiscal year entirely or even 3/4 of it. Again, most of the numbers are going to be fairly consistent going from year to year. The point is to try and identify some priorities that might change some of the numbers next year. But your janitorial contract is still going to be your janitorial contract. You're still going to have utilities. You're still going to have an elevator contract if you have an elevator. You're still going to have maintenance and repairs. And so beyond the extraordinary, the basic movement, again, is to try and do your best guess on how much price is going to go up and build in anything that's special that you want to do for the next year. So we're pushing out to the managers in August. So we've already started to about 200 budgets that will be coming to the managers for their review and then going out to boards. Those are properties that are generally below $2,000 a month in terms of fees. The September, we're going to do another about 150 properties. And those are going to be for our highest management fees, so our largest properties for the most part. And then those will be pushed out to the boards then as well. And in October, we'll do kind of the middle of the road and get those out to boards. All this is an effort to get boards, and so I'm glad we have board members on the call today, but to get the boards to schedule their meetings or schedule however they're going to review the budgets with their managers and or their owners, but to get these things set up early. Don't wait until the week between Thanksgiving, and the beginning of December. We need to have this information by December the 6th. That's the deadline we're going to set in order to get approved budgets in so that we can get the budget uploaded to the system, get the fees set up for next year, and get notice out to owners. All three things need to happen. And when we're doing, again, we have about 475 of these that we're going to be doing. We can't do them all if boards are approving their budgets in December. So I'm urging you, I'm pleading with you to work with your managers and try and set up these meetings and get things done in October and or in November before Thanksgiving, so that we have adequate time to get out notice to your members and do the back office work that we need to do to get things set up. So December the 6th, that's the big number I'm trying to give to people. That's when we need to have the information in hand. So work backwards from that. If you need to have a meeting a month before that, or if you're going to have a 2 meeting, I don't know what your process is for your individual board. Maybe you meet as a board first, or maybe have a finance committee that meets, and then the board meets, and then they meet with the members or not. I don't know what your process is, but try and think backwards from December the 6th, what you need to do in order to make that happen.
Hey, Sam, do you have an estimated date for drafts in October? So is your team looking to push them out on the 1st and the managers are going to get them out by the 10th? Or do you have a thought in your mind already on what that's going to look like?
I don't have those exact dates, but I do know we're doing it on a rolling basis. So we're not going to wait until, we're going to try and finish the October budgets by early October, maybe by the 10th, and then make sure they get to the managers and then they get out to the boards. And so, but it will be on a rolling basis, so that we're not saving them all up and then going to do them all at one time. So we're doing them every day. We're sending out budgets as we complete them. For example, for the August ones, we've already rolled out 200 of the 225 that we're going to do. So today is August 15th. So we have about 10% left to do in August. And then we're already starting on the September budgets as well. So we're trying to be effective and get them out as early as possible.
Awesome.
If you approve your budget and get it to us after December the 6th, we will make the first effective date for the new fees will be February 1st, and we'll do a small catch up. So for example, if you raise your fees $10 a month, but you don't get us the budget until after December the 6th, then what we will do is we will have on February 1st a one-time catch up of $10 plus the new fee will go into effect on February the 1st. All right.
Sam, real quick, a board member's asking if there's a way for them to set up a meeting with someone else besides just their manager to go over their budget. If there's a way to set up with someone on your team, for example.
Yes, I mean, we have a couple people that they could reach out to. And so here, I'm going to do this live here.
You want me to do that? Is it Lisa or Andrew?
Yeah, it's Lisa.
Okay, I'll put it in the chat.
Coffee at EJF. Well, actually, you're probably right. It probably should be Andrew. So I'm sorry. It would be Andrew.
I think, Sam, it might actually make sense to route that through the manager still, because I think we still, even if you want to meet with someone else on the team, I think that we still want the manager to be involved, because the manager is obviously going to be intimately involved with your budget in the year passing. And so yeah. I think the best way to do it, honestly, thinking through it, would be to have the board request, hey, we'd like to meet with someone else on the finance team, and then we can organize that through your manager for you. I think it actually might be the better way, Sam, than having boards approach someone on your team directly.
They probably should, yes. That person could be Lisa or Andrew on our teams who would be in that meeting, but yes, they could ask through their manager.
Okay. And then a question about special assessments is if they want to have a special assessment, can they do it at any time or does it need to be put in at the time of the annual budget?
Special assessments can be done at any time. You need to look at your bylaws just to see what the process is. In other words, a lot of boards have the authority to, impose a special assessment. They don't need the approval of their owners. Sometimes the bylaws will say it has to be approved by the owners or a certain percentage of owners. So just be aware of what your limitations are, what your process is in your bylaws. But a special assessment can be done anytime during the year.
Okay.
So just a few overarching things about our budget process. I just want to remind everybody that 99% of our budgets are zero-based budgets based on what we anticipate the association's expenses will be. So if you've ever been in a budget meeting with me, I don't even look at the income. I go right to the expenses, because if the board agrees that these are what the expenses are, these are the reasonable, expenses for the upcoming year, then the fees just have to cover it, whatever that is. If it's a 1% increase or a 20% increase, if these are the expenses that we know we're going to have, and then, this is our fiduciary responsibility to set it up. And again, in the bylaws, it says that your job is to cover all of the expenses and the reserve contribution. And so, but at the end of the day, well, the way we build your budgets is you adjust the expenses until you agree on what they are, and then the income will automatically calculate so that you have a zero-based budget. In other words, your bottom line will be zero. You're going to bring in just as much as you expect. There are some rare cases where a board may want to budget for a small surplus. You might want to be rebuilding your equity, or you need more cash in your bank account, so you want to have a surplus. If you're going to do that, you can let your manager know. We can adjust the budget to make it so that you can have a bottom line that is not zero, but 99% of the budgets are a zero-based budget.
Sam, just on that front, because it came up a couple times in last year's budget cycle, we do not budget for deficits. And that is something that when people go to finance or refi or purchase, that is a big no-no to show on the books. And so I know we had at least 2 or 3 clients last year that decided they wanted to budget for a deficit. And I want to put that out there that should not be done. And that's not our practice at EJF.
Well, not only is it not our practice, but it's against your bylaws. The bylaws do not say you can budget for a loss. They say that you have to cover all the expenses and the reserve contribution. That's the first thing. Second thing is, a lot of times, some board members may not understand. They'll say, well, we had a surplus last year, so let's put that in this year's budget. Okay, so that is definitely not proper budgeting. There's no surplus from last year that carries over into this year's budget. If you had a surplus, that means that your cash balance would go up, which is fine. That would build your members' equity, which is fine. But your budget has to be either zero-based or positive. It cannot be negative. Your CAM, that's your Community Association Manager, is going to review the budget, apply their knowledge of the property to ensure the budget is accurate as possible. That's before it comes to you. They're going to share the budget with the board for review and possible changes, right? So that's part of the process, and hopefully you already have a process with your manager that you've worked out in a timeline. The board approves the final budget. So again, this is not something that we can do. We do need a board to have a meeting, a properly advertised meeting, and they have a motion made, and that the budget gets approved formally and is in the minutes. So please do make sure you're doing that as part of your process. Once you approve the budget, send it to your CAM, your Community Association Manager, and they'll send it to the accounting team for implementation. And then we'll set it up to get it posted into Vanica so it shows up on your financial reports, getting any communication the board wants to owners, and then also adjusting the fees if the fees have changed for the next year.
Sam, question from the chat. Do you look at the prior year income to detect chronically delinquent owners?
That's a great question. So, yes, of course, in the budget process, if you have a number of owners who have not paid over time, first thing is, I hope you're aggressively pursuing those owners and trying to foreclose on them and get them out of your community. You know, I mean, I'm not talking about people who have special cases where they really have hardships, but if you have people who are just not paying and they like you paying for their water, I hope you're doing everything you can to get them out, because they are really crippling your community. But if you know that you're, again, I'm making this number up, but if you know that your budget is $100,000 to cover your expenses, and you know that there's going to be $10,000 or $15,000 of that you're just not going to collect, then you should add into your expenses a bad debt. You should add that as an expense, and that is going to increase everybody else's fees. But you have to do it, because not collecting 15% of your budget, like if you had a $100,000 budget, you're not going to collect 15,000. You need that cash. I mean, it's not like your bill is going to go down. Your bills aren't going to go down by 15%. You have to collect more from the people that are paying, which should make everybody mad, of course, and you should try and get the non-payers out as fast as possible. But yes, if you know that you're not going to collect some, you should be budgeting for bad debt so that you can have an adequate cash flow to pay for all your expenses.
Okay, follow-up question, not from the same association, but totally linked. What do you recommend if you didn't get $20,000? The members are gone now, right? Is that the bad debt write-off? Is that something that can be written off in taxes? And this is for this particular question, Sam. You were talking about making this as an operating expense, but this particular question is, we've done what we need to do. The shareholders are out, and now we just have this 20K, for example, sitting on the books, and we're going to need to write it off. Is that a tax thing? Is that something that a tax professional needs to answer directly?
No, I can answer the question. So there's a couple of nuances here. So first of all, if the person is gone, you have a choice to make. Are we going to pursue them legally? And to do that, you need to understand what the costs are going to be. And there's going to be costs that you will have to pay up front, and you may or may not get the money back. So you have to decide, is this person a good prospect for us to get the money out of them? And should we pay somebody legally to pursue them? If you just don't think they're a good prospect, you just know they're a deadbeat, they're never going to have a job, you're never going to get the money, then you should just write it off and not spend the money on legal because that's just going to be bad money after good money. So don't do that. So if you decide, A, you want to pursue them, then you should do so. Or B, you decide not to pursue them, that's fine too. Either way, you should write it off your books now, because it's just sitting on your accounts receivable. This person has already moved out, and you're probably unlikely to get it. My experience is that in 95% of the cases, you're unlikely to collect this money from these people. Just unlikely. It's just the way that it is, unfortunately. So again, you have to decide if you want to pursue them or not. That's a different decision. But I think you should write them off. And the way to write them off is you should have a board meeting, and you should make a motion to write off XYZ's amount for XYZ dollar amount, right? So we're going to write off Fred Smith's amount for $20,000. Somebody makes a motion, it gets seconded, it gets approved. And when that's done, your community association manager should pass that on to the financial department so that we can write it off your books. Let me be clear. Writing it off on your books does not mean that you cannot pursue that person. It just means you're kind of cleaning up your books and making them look the way that they should look, which is that we don't have this money on our accounts receivable list. It doesn't mean you can't pursue it. Again, like I said, it's two different decisions. Should we pursue it? But yes, you should write off, people have already moved out, you should write it off. Whether it's $10,000 or $200,000 you're carrying on your books, you should put that in a motion in a board meeting and write it off.
Sam, back to the operating shortfall for delinquencies. Will we be highlighting that in the draft budget? Like, if we've looked at it and we see that you didn't collect 15K for 15% for the last 2 years, is that something that's going to be in the budget notes for the board to consider? Are we going to bring it up to the board?
It is not something that we generally put in the budgets, because that would be like this second step here where the CAM reviews the budget and applies their knowledge, and they should be talking with the board about that. I will make a note here and make sure that we are giving our CAMs a heads up about that to make sure they know that. But we're not digging into receivables when we're trying to do the 525 budgets we're doing and getting quite that deep. that's where the CAM would apply their knowledge and say, look, we know we're not going to collect this. We should build in bad debt. But I will give a heads up to in one of our CAM's meetings about doing that and making sure that they understand that that's on their plate. It's a good question. I'm making a note to myself. All right. Okay. Any other questions on this slide here?
I think we're good.
All right. Great. Great questions. Okay, a little bit here in the nitty gritty, but this is just to give you an idea of some of the format, what you can expect to see. So our format provides the board with pertinent information to help the board make good financial decisions. We give you a 3-year history of past performance. We give you the current year's performance to date and a projection for the remainder of the year. We also give you the current year's budget and then a proposed budget for 2025. So these are kind of the columns that you're going to see. You're going to see an actual for 2021, an actual for 22, and actual for 23. So that's your 3 years prior history. We're going to give you the actual through a certain date in 2024. Depending on when you get your budget, it might be May, could be June, could be July, could be August, could even be September. But then we'll give you a projection for the rest of the year. And again, a projection is our best guess. And, you should look at those numbers, but you also need to make sure those numbers come out accurately, obviously. Going to give you the approved budget for the current year that you have. And then we're going to give you, I'm not sure why the approved budget is in here twice. That's a mistake, to be honest with you. And then you're going to get a proposed budget for the upcoming year. This particular budget happened to be, I took a copy of somewhere. This budget happens to be a 630 budget, but yours will be a 1231 budget. But anyway, just to give you an idea that, so you have plenty of data to look at. And that goes back to my earlier comment, which is you can do a budget in August or September, or October, just because the year is not even 3/4 of the way through, is not really going to drive the boat in most cases off the course, because you've got plenty of data to see, what your contracts have been, what your maintenance and repair experience is, what your administrative costs are, and things along those lines.
2 quick things from the chat, Sam. One of the questions was, are we providing these figures to the managers? And the answer is yes. The manager will get the exact form that you're going to get, but they get it first. They're going to review it because the accounting team puts together the draft budget, but then the manager applies their unique knowledge of the association to it. So yes, all of the figures that Sam's presenting here will be presented to your community manager. The next question, I love this one, is the projection for the remainder of the year just a formula based on the first part of the year, or an informed judgment based on what's left, Sam?
Woo, put me on the spot there.
I know, I like this one.
We give it to the managers as mostly a formula, except for a couple of areas where we know it's not formula based. But then we are, telling the manager, you need to look at those projections and go through them and try and make sure that they are as realistic as possible. I'll just give you a good example. We're required to pay your state taxes ahead of time. So you pay in $250 ahead of time. Well, obviously, and we pay that usually in the first part of the year. Well, we shouldn't be dividing that by 12 and then multiplying out to the rest of the year, because we're not paying anymore, right? We've already paid it in. And so that's a line where we try not to divide it by 12 and then, have it amp up to some bigger number. So, again, trying to be as consistent as possible, but we do need to rely on the CAM and the board to look at those and say, that just doesn't seem quite right. Again, the projections are kind of important. I would actually focus more on the prior 3 years and the current year to date. I mean, the projections are good guesses, but our experience is that for the vast majority of boards and communities, there's not a huge variance in how these numbers work through from year to year, unless there's extraordinary things that happened. And again, extraordinary things are not really what you're budgeting for. You can't budget, for example, for the fact that you had a water leak last year that cost an extra $20,000 in maintenance and repairs. Is that going to happen again this year? It's possible, and you can make an informed decision because we know our building is old and we haven't gotten to replacing the pipes yet. So we want to budget for that. You can, but that's not normally the kind of thing you budget for. So again, by having multiple years, you're able to look at these numbers. The projections aren't the most important number. I'd rather look at the past actual experience and let that inform my decision about where I want to be for next year.
I will say that the model is based on looking at the frequency of payments in the year and the prior year. So if we see that you pay this bill 5 times a year, then it's going to base it on that. Just a thought on that, Sam. That's the way that works out. And I think the other really classic example of this outside of taxes is snow removal. As
That's
you
right.
mentioned before, you don't spend snow removal 12 months a year. The other one that's always weird is insurance. Some insurances pay all at once, some make you pay a quarter and then you pay, 8 more payments. So we do try to take that into account when we're making projections. But Sam's right, the projections, they're projections. They're not solid numbers. So and then we have a question about the allocation tab, but I think you're getting to that now, right, Sam? The
I
next.
am actually, and your thing on insurance is a good segue also. So let me just say here that in on the documents, you and the CAM can adjust expense numbers only, and then the income calculates automatically, and the totals for each section calculate automatically. But you can adjust any expense number, which again, those are the important numbers because whatever you set to be the expenses, your income has to cover it. The expenses are where you can make adjustments. The expenses in this column here where your proposed budget is. All right. We give you other information, other tabs. These are built on Excel spreadsheets. So you have other tabs that are available to you. One of those, for example, is insurance. On the insurance tab, we give you a multi-year history of what your insurance costs have been over the last few years and what they're projected to be for the next year. So that's a useful thing about it. It tells you when your policy is going to renew. It tells you what type of policies you actually have. So that's a useful piece of information if you're not familiar with that for your association. On your utilities, we give you a breakdown. What have your costs been over the last 12 months? And we show you what those are so you can see utilities. Capital expenditure. Your capital expenditure budget, your reserve budget is a totally different budget. And on this tab, it should be your upcoming expenditures based on your reserve study. Your allocation tab is setting for you when we think the expenses are going to happen. So we do try and anticipate and look at that. And then when we post the budget, we try and put it in. So as Mira said, a good example might be snow removal. We don't allocate snow removal across 12 months. We only allocate snow removal over 5 months, November, December, January, February, and March. That's when you generally are paying snow removal bills. You're not paying any snow removal bills in July unless for some reason the bill got lost and you're paying it late. But that's when you're budgeting for it. So we do try and allocate your budget based on some knowledge that we have about when your actual expenses are going to happen. And then, of course, you have the fee sheet, which, again, you won't be able to adjust, but should give you a lot of detail. And we try and break it down as much as possible so that your detail reflects and gives your owners information. What is their ownership percentage? What's their parking ownership percentage? What's their storage ownership percentage? What's their storage fee? What's their parking fee? What's their parking assessment? All those things get broken out until it gives you a total that the owner will be paying for the next year. So we try and give you a lot of detail there so owners can understand exactly how their fees are calculated. A lot of owners think that, or I don't know what they think, but a lot of owners don't understand that there's a direct connection between their ownership percentage and what they get charged, right? And then there's no magic here. It's pure science. It's pure math. When you bought, you were assigned, your unit was assigned an ownership percentage, and that's what you're going to pay every year. And then finally, I just make a note here that you do have a notes column over to the right, and I urge you and your CAM to use this as much as possible. Put information in here. If you make some assumptions about this year, put them in there. Put maybe who your vendor is. Do some breakdown. Give yourself some notes because those notes will be useful for next year. They'll also be useful as you move through the year and you're trying to decide, well, gee, where exactly should we categorize this expense? And you can look at your notes and often remember, oh, yeah, we talked about this. We want to put it under maintenance and repair under HVAC. That's where we decided to put this. So the notes are important. All right. So again, this gives you a nice view into some of the nitty gritty about how the budgets will be presented to you. And then on the fee sheet, so just as a reminder, as the board adjusts expenses, the fees are going to automatically recalculate, right? It's set up. So again, if you want to adjust an expense, you raise an expense by $1,000, then the fees will go up. You lower an expense by $1,000, the fees will go down. It's all done automatically for you. Again, we break down the fees as much as possible and give you detail about every charge to provide owners with a clear view of exactly how the fees are calculated. We don't want there to be any mystery here. We don't want the board to be in a position of having to try and explain this and say, well, we didn't just make this up. We want to be able to have the owners look and see how these things were done. So this is just a sample of how it might be broken out, by we give a unit number, give you their, if they have their parking number, the parking space number, what their ownership interest is, how much they're paying annually, how it breaks down monthly, and then how that changed from the prior year. So again, this is just a sample of what your fee headlines should look like. And then of course you have the numbers below it. In most cases, boards should expect fees to increase somewhere between 2 and 5%, depending on expenses and increased prices, assumed or contracted prices. Boards who have not raised their fees in several years may see much larger increases. It's not realistic to not raise fees because expenses are increasing. Again, we have many boards that push back and say, well, we can't raise fees. And my response is, your job is to cover all of the expenses, the realistic expenses. And so if that means fees go up, you need to raise fees. And certainly given the last 5 years and the amount of inflation that everybody is aware of, if you haven't raised your fees in the last 3 to 5 years, you definitely should be raising your fees, just flat out. There's just no way you should not be raising your fees. So a lot of people will say to me, does that mean fees are going to go up every year? And my answer generally is yes, you probably should expect them. I mean, just like your real life is. People often confuse a mortgage and a condo fee. Your mortgage, if it has a fixed rate, is not going to change over the 25 or 30 years that you have that loan. That's set, fixed rate. Condo fee is not fixed rate. When you buy a condo, you're essentially buying into a business. That business has to operate in the real world, and in the real world, prices have increased. This is basic stuff, I know, folks, but sometimes people really are resistant to this, and I have to explain to them. Do you think your condo cost the same 15 years ago to cost today? No, prices have increased. The same thing happens to you. You are running a business in the real world. You're paying for services, and these services do increase their prices. Prices go up. And so your fees are going to go up probably every year. It might be as low as sometimes, maybe some year, maybe you can get it down to 0.5% or 1%. But in general, over time, your fees are going to increase. And I know this is going to lead to the inevitable statement by somebody that says, our fees are already a lot more than everybody else pays. If I could have $1 for every board meeting I've been in, when that gets said, I could not be on this phone call. But other boards also face the same pressure. So other fees are also going up. And sometimes people will say that their fees are higher than everybody else. My general response to that is that it's very hard to compare fees because buildings have different amenities, different location, different size. There's so many factors that go into it. What I try and focus on are units in your building selling? Do they sell pretty quickly when they're priced appropriately? And in general, are the values going up? And in most cases, when you look at it like that, the answer is yes. Right now, units should be selling. There's not enough real estate on the market. And so you should see units selling pretty quickly. Again, you could have a case where some fees are outrageous compared to what it is. You have a small 1-bedroom apartment and a building has no amenities, and for some reason the fees are, $850, and there might be something wrong there. But again, with the board's help and your CAM's help, you get those expenses to be as realistic as possible. And sometimes it's distasteful. Sometimes people say, well, gee, we don't have any amenities and our fees still seem like they're a lot. And the answer is that sometimes that's just the way that it is. It's unfortunate, but your building is expensive to maintain. You have an older building, you have different issues. Sometimes that's just the reality of the building. So I'll stop on that. But the last thing I do say here is that it is paramount that boards use, and I put it in capitals, realistic expenses to set a budget. Wishful thinking or cutting reserve contributions in an effort to not raise fees will only lead to special assessments and increased costs in the future. Okay? There's just no way around it. I've done this too long. If you have maintenance and repair costs over the last 3 years that are $15,000 and you budget $5,000, you are going to be out of money and you're going to need a special assessment. So, it's just, again, if you read your bylaws, you're supposed to set the expenses at what it actually costs to operate your building as a best practice, and then make the income cover those expenses. All right, I'll stop on that. I feel like I'm drilling that down, but it's important. A final word on fees. Again, we're going to do our fees based on industry best practices, a sober review of expenses, feedback from vendors, and our experience in managing hundreds of properties. To meet this goal, some associations may need to increase fees. We are not oblivious to owners' reactions to fee increases and sometimes real hardships. We understand that. We live in the real world too. And sometimes I remind boards that, if owners object, you need to make sure the owners understand, as a board member, I'm not really looking forward to this. I have to pay it as well. But it is the right thing to do for the community, right? It is what the community needs to do. And we need to not vote on what we personally want, but what's the right thing for the community. So the board is required by the bylaws to pass a budget that covers all expenses and an adequate reserve contribution. This may lead to an increase in fees and sometimes a substantial increase. Those could be a tough decision. The board must meet these standards. That's what you're required to do. And you have to pass something that's best for the association, not their own pocketbooks. All right, last but not least, our budget goals here are to give you a realistic budget for 2025 in a timely manner, meet with and guide the board through a review of the budget and make adjustments as needed, have the board approve the budget before the end of November to allow proper time to upload the budgets, support the board and meet with the community at large if needed. And so, there are some cases where it's going to be a hard presentation because your fees are going to go up and those kind of things. So again, your manager can help you with that. I have people on my team that can help you with that. There are a few cases sometimes where even I come to those meetings and, I deliver the bad news. I'm the bad guy. And that's okay. That's part of our job sometimes as your management company. Sometimes we have to be, explain that. In most cases, when I'm on those meetings, I go through in pretty thorough detail and people understand it. I didn't say they liked it, but they do understand it. And in most cases, they're able to accept it and they make the adjustment that they need to make. And I want to remind you that this is a collaborative process. Neither the board nor EJF is 100% responsible for getting this done. We're both responsible. We have roles to play and timelines to follow. So we rely on the participation of the board to see this through to a successful conclusion. And we look forward to working with you on this because a good blueprint for next year will help set us up for success, both of us for success. Well, it was 11 slides. I hope to keep it to 10. Sorry.
I made a question slide, Sam. You know how I am. I have two questions that came up while we were talking that I asked if we could hold to the end. So they're kind of related. In the first one, there's an association that's concerned with the costs associated with the new energy benchmarking requirements in 2025. And it's a small building that's been quoted $10,000 for the energy audit. And so the question was, should they include an estimate for the large professional fee for the energy audit that may or may not be needed in 2025, or could that be considered a CapEx instead of operational?
Wow, you have about 3 questions in there. 3 or 3. So the first thing is for those who don't know, DC requires buildings to benchmark. So, and the requirements are based on the square footage of your building. It started off at buildings that were 100,000 square feet or more, then it dropped to 50,000 square feet or more, then 25,000 square feet. This has been over the last about 10 years. This year, it's going down to 10,000 square feet or more. So if your building falls between 10,000 square feet and 25,000 square feet, 25,000 square feet was the last threshold, then you're now falling into what's called DC benchmarking. You're required to report to DC certain elements of your building, and you have to require your energy consumption. It has to be filed through the DC energy department. You have to fill out the right forms. You have to get readings off of your Pepco meters and your gas meters and your water meters. Anyway, we actually help you with this. We have a service set up to do this. We have a contract to do this with them to try and drive down prices for you. And if it's your first year in this, and again, this is something, again, that should be in your budgets, is that then you're going to have to pay to get those things done. It's going to cost you probably about $2,000 in your benchmarking cost just to do the reporting, right? To get the information together, put it into the right forms, upload it to DC, and make sure it's all done properly. It's going to cost you about $2,000. That's
Sam,
DC. That's DC benchmarking. And again, if your property now falls in that square footage, that's going to be a new expense for you.
two things before you move on to the budgeting of this. One, Montgomery County, don't think you're special. You guys are also getting this now as well. It is Montgomery County is subject to benchmarking. I'm not as confident of the sizes, but we have the same group that we work with for our DC clients is monitoring the Montgomery County side. And there's also subsidies from Montgomery County that help offset your costs. So it's not as important as a budgetary issue. The other question was the square footage. Is it just the common elements? And no, it is your gross square footage of your building. So it is units, hallways, garage space, courtyards. All of that is included. It is gross square footage, not just common areas. So just wanted to answer that question that came up.
So that's what benchmarking is and why you may see this as a new expense this year. And yes, $2,000 for a smaller building could seem like a lot. This is not something EJF is telling you have to do. This is something that DC is mandating. And so, it has to be done. Your question was about an energy audit cost. So again,
Sam, before you answer on the energy audit, somebody did comment that 10,000 seems very high for an energy audit. So I wanted to, I don't know if you have any visibility on what makes up those costs. I don't, but I just thought I'd let you know that question's in there, and the suggestion is that we bid that contract. And so I just wanted to see if you had any visibility on that.
As part of the benchmarking process, the goal here is to reduce the energy consumption of buildings across the city to decrease our footprint. This is all kind of tied to global warming and some bigger goals. But for DC, they have this ultimate goal of driving down their energy footprint, and they're mandating that buildings get on board and do this. So as part of this, you're going to get a score, and your score has to be, I think it's below a certain or above a certain amount. I can't remember, Mira, but your score has to be in a certain level. And if it's not at that level, then you're going to have to take action on your building in order to decrease your energy consumption. Now, all this doesn't happen in year one. This is a phased in thing that happens over many, many years. But ultimately, when you get to the point where you have to have your energy level consumption reach the goal that DC has set for you, if you're not reaching that goal, there are some real severe penalties that they have built in. But it's about a 5 to 10 year roll up. So this doesn't all happen in year one. The start of this is benchmarking. And so you can get an energy audit now to see how you're using energy in your building and make recommendations that can help reduce the energy consumption in your building. This goes back to the utility thing I was discussing before. You don't have a lot of control over the pricing, but you do have control over consumption. So if you can reduce consumption, you can try and mitigate some of the price increases that you might feel. So an energy audit is one way to do that. I highly suggest you get multiple bids. I don't know the size of the building that this person has, so $10,000 might be a lot, it might be little. It depends on the size of the building and what they're going to do. But there are many companies that do this, including the company we work with can help you get some bids on this. And so you can talk to your manager and they can talk to that company and help you get, some different energy audits and maybe give you some advice on them as well.
So Sam, I think we're kind of getting into the weeds on benchmarking, and we
are. Sorry.
5 minutes left. I want to run through real quick. The benchmarking cost that they had this year was not on their budget for 2024. Do you have any? I don't know. We can look into this particular association. I do believe that we didn't have as clear an idea of the costs last year at this time as we do now for next year.
Right. I think probably last year we missed in some cases getting on so there was a new requirement from DC that your building had to be measured this year. So they were no longer going to accept what you said the square footage was. They wanted it to be professionally measured.
Right.
And we tried to get that set up before the budgets, but we did not. And so there probably was a miscommunication there about putting in even something for that. So I apologize for that.
And then just because I want to move to the actual budgeting question, so I want to knock out these last two questions on benchmarking. Associations, DC maintains a list of what addresses are subject to benchmarking, and the third-party group that we work with monitors that list. They have a list of our associations, and they let us know. And so we will let you know as your manager if you're subject to it. And then an energy audit and benchmarking are separate. And if you want to drop your name in the chat or email me, mira.brown@ejfrealestate.com, I can give you kind of a breakdown of that. But I do want to let Sam get back to you. The question was, and it dovetailed to the second question that had been dropped in the chat. We have a large planned expenditure next year that is completely non-operating, but is it CapEx was the first question, but then the second question was not benchmarking, but it was the same idea of, we know we need to spend a large quantity of money that's outside of our normal operating. Should that be a special assessment? If we have the money in our reserves, is that can we make it a CapEx? Was the question, Sam. Can you answer on that?
Yeah, in 10 words or fewer, right?
So I mean, you have 2 more minutes.
If you're doing something that's outside of operations, especially if you're replacing something, right? If you're, taking some old out and putting in new, then in general, that's going to be CapEx. And so in general, you should not have in your operating budget, put in your CapEx budget. And yes, you should be using your reserve funds to pay for that. Now, the other question is, though, suppose in the reserves, we never had this budgeted, and so therefore we haven't been saving for it. Well, okay. So in that case, what's going to happen is that you're going to use your reserve money for something that you haven't been saving for, but really is a capital expenditure. So for some reason, it wasn't in your reserve study. And when you get your reserve study redone, updated, the starting balance will be lower because you used that money for something else. And therefore, it's going to increase what you need to be contributing on an annual basis to make up for that. And then you're also going to be budgeting for that replacement, whether it's 10 or 20 or 30 years down the road. So the answer is, ultimately, the board has the authority to decide we want to take this out of reserves or not. As a practice, hopefully you've been saving for this project. If you haven't been, then just understand that when you get your reserve study updated, your annual contribution is going to go up. But the board has the authority to say whether it's a capital expenditure or operating expenditure. Sometimes you can even do both in some cases. So that's a pretty short answer. Sometimes these are more complicated. Again, you can reach out to your manager. You can reach out to somebody on my team, and ultimately it might even get to me to help explain that in a little more robust way. But that's the basic answer.
I think that's a great overarching kind of tie up to this, Sam, is that these kinds of specific questions are exactly why we encourage you to have a meeting with your CAM to go over your budget. And if you think necessary as the board, to escalate the meeting to members of Sam's team. So those 2 questions, I do think a lot of our boards are facing those questions overall, but I think Sam's right. Each association is different. And so that may be a case-by-case thing that you should bring up with your manager, but definitely in the course of the discussions, bring this up. We know we want to do the 3-tier pipe replacement this year, for example. Those are pertinent things that we want to be involved in the discussion with. So
actually, I'm going to drive us over here a little bit, but this is a good time to say this, is that in our industry, fundamentally in our industry, since the disaster in Florida 2 years ago, there's been a lot more focus on reserve projects, and making sure that they're getting done on time. And I'm sure that some of our boards, if not all the boards, might feel that pressure. But if you don't, you're going to feel pressure. It's going to come in one of a couple of ways. Legislatively, already in Maryland and Virginia, you are now required to do reserve studies. And in Maryland, you're required to fund them 100% of what it says. DC is talking about such legislation. That's just legislatively. Just intuitively, there's obviously been a lot more focus on this as well. So again, your board should be really working on 2 budgets, which is your operating budget, which is the main budget and drives fees, et cetera. But you should be looking at that CapEx budget as well. And what's coming up and what's in our reserve study? What should we be doing this year? Should we put it off or do it now? And so those kind of questions are really important. And I think it's worthwhile saying that we as a company have recognized this kind of growth area in terms of importance. We have actually stood up a team specifically aimed to help you. Yes, it does cost a little extra because there are real professionals that are helping you. But we have a team of people here now that are professionals that can help you with these projects and can help you make these kind of assessments. And then we also have a team that can look at how to pay for it. Should we, is it going to be a loan coming out of our current capital reserves, a combination of those things? If we're going to do a loan, we can help you get a loan. And if you can do a special assessment, we can help you also do a special assessment. So we're here and prepared to help you.
So recognizing that we are past 1 o'clock, I do want to say that I'm going to call this to a close, but if there are any questions, Sam, are you pressed up against another caller? If there's anybody that wants to come off mute and ask a
I
question.
will stay online right now and answer questions from people, not a problem.
Okay, so thank you all for coming. If there are questions, raise your hand and I will take you off mute and you can speak directly to Sam or me about your questions. Or otherwise, I will remind you that we do this every third Thursday at noon. And next month will be responsible annual meeting planning and how to build for success there. So we do have someone who's asking to have a question. So Doug, please go ahead and take yourself off mute and we will be happy to answer your question.
We have guidelines for the replacement reserves. I'm sorry. We have guidelines for the replacement reserves in the reserve study. We have no guidelines in our audit for the operating reserve. Do you have a percentage that is a general guideline for the amount that the operating reserve should be based on our assessments?
In general, I'm not a big proponent of operating reserves, to be honest with you. I would want to look at your financials and understand what this operating reserve is and why do you have an operating reserve. I mean, operating reserve is effectively saying we're going to take a bunch of extra money and set it aside in case one of our expenses turns out to be more than we budgeted for it. And again, have you been doing it for multiple years? Have you ever used that money? Are you just building up this pot of money that's getting bigger and bigger and bigger? Has it been properly accounted for? I mean, there's a number of questions. My general advice to boards is to say that the direct answer to your question is no, there are no guidelines that are going to be in the audit, and there's no best practice in the industry about how much an operating reserve should be. That's a direct answer to your question. I'm just saying to you that most boards don't understand how to use an operating reserve. They don't understand when to use it and what it's for. And that's a conversation maybe I should have with you and your board just to try and help you understand. In most cases, I say just put it in, if you have something specific in mind, put it in that line item in the budget. But, what is just general maintenance and repairs? Operating reserve starts to be complicated in terms of actually properly accounting for it and knowing when to use it and how to use it.
I see operating reserves as each year at the end of the year, you have an over budget year or you have an under budget year. That's where ours has built up. And it's probably too high. So yes, we would like you all to look at that. And we have an expense coming up that is going to be a large expense. We're going to put new doors on the front of the building that is not in the replacement reserve study.
Okay.
Which is what you were talking about before. So we could use that money for those new doors. They're going to be automatic handicap doors. Okay. Next thing is, do you have a percentage as to where our operating account, our cash operating account should be based on the assessments? For instance, in your personal bank account, you don't keep too much money in your operating account. Do you have a guideline for that?
Absolutely. This is a great question, by the way. I don't know how many people are still on, but this is a really important question. The answer is you should have at the end of the month 2 times your monthly assessment in the bank.
Okay.
That is
in the operating, Sam, just to make that super clear.
In the operating account, yes, in the operating account. That will provide you in 99.5% of the cases, that will provide your association with adequate liquidity in order to deal with the fact that, bills don't come in 1/12, right? You collect your money from owners in 1/12 amounts, but your bills don't get paid out in 1/12 amounts, right? I mean, some months they're a lot more than other months and lots of variances there. So you need adequate capital. And yes, you don't want to keep too much, but you don't want to keep too little. 2 times your monthly assessment is what you should have at the end of the month, give or take, but that's the goal.
And Sam, that kind of dovetails to a question that's in the chat, which is there DC law about moving money from reserves to cover operating shortfalls? And so I think that drives at, are you keeping an adequate amount in your operating account to cover your operating bills?
So the direct answer to the question is there are no laws pertaining to, moving money from reserves to operating to cover costs. As a best practice, and certainly as just good business operating, you should never take money from reserves and pay it for operating and then not pay it back. Sometimes you have to do it on an emergency basis. Sometimes you have to do it because you've underestimated your budget. You need to have an adjustment or you need to do a special assessment. So you always need to give the money back. Otherwise, I try and get people, I don't know, obviously we're not talking to Doug Morrison. I don't know who we're talking to, but the lady spoke and she gave a good example of, in your personal account, you build up your 401k. But if you borrow the money from your 401k to pay for something extraordinary and never pay it back, then all you're doing is shortchanging yourself in the future. So you need to pay it back.
Okay, we have another person. Carol, you can go ahead and unmute if you'd like to ask your question live.
Hi, yeah, thanks for this. Really helpful. Just on the theme of operating reserve, I actually think it is important to have a buffer, and even though you're not a believer in operating reserve, you basically just said you should keep about 17% in your bank account. 2 times your monthly would be about 17% of your annual income as a balance to absorb volatility. But let's say that we have targeted a higher cushion for our operating because we're fairly new and we don't have, let's say, we have a lot of surprises because we're new and we're still learning.
Yes.
We set aside kind of a target amount for this year, and EJF has been commingling that operating reserve amount with our capital reserve in the same bank account. And I've been insisting that that not be commingled so that we keep those straight and to just leave it in the operating account. Do you have any comment on that, on the appropriate, managing of that cash?
Sure. You use the word commingling, and sometimes people think of that as a negative thing. So yes, it is true that we keep your reserve funds, whether they're operating reserve or long-term reserve funds, in the same bank account so that they earn some interest. And it is true that you could break it out into a separate bank account, but it is kept on your balance sheet. So you know what the balances are in each of the, in each of those buckets, I'll call them, right? So the fact that they're in the same bank account, in my mind, doesn't make a difference. It's still cash. If I have 2, 3, or 18 money market accounts, it doesn't make that much difference. Sometimes it's easier for people to make that understanding in their mind about, well, this money is for that and this money is for that. But that's on your balance sheet. You have a reserve section on your balance sheet, and one of those items is going to be operating reserves. And so you can see right there, of the money in my money market account, $10,212 is for the operating reserve. So I don't see why we would need to have a separate bank account, right? It's just more work. It's another account to keep track of, another account to reconcile. And it's one more way for things to go wrong because we have to put this money in this account and this money in that account, and it creates more work. But it is on your balance sheet broken out.
Okay, I guess the other option is just to leave it in the operating account.
You can leave the operating account, but again, most of the time, hopefully, you're not having to touch that money. And so again, you said a couple of good things here. You talked about this is a new building, and that transition can be painful. 92% of the time, the budget that the developer has set out for you is severely, sometimes moderately, but often understated because they're trying to keep fees low when they sell their units. And then it turns out, well, gee, wait a minute. We have an elevator. We have to have an elevator contract. That's not built into here. We need to build in something for elevator maintenance and repairs. We need to build in, a roof inspection. These are things that developers rarely build into their budgets, but need to be done as a best practice to keep your building maintained and in good shape and to prevent future costs. So it's often painful in that first 2 or 3 years in that process. So you're right. Sometimes getting that cash balance up is difficult. Depends also on how you transition from your developer, what other issues there are. Do they give you any cash to start off with? There's a bunch of overarching things here, but I think it's okay if you're not severely limiting your operating account to keep it at 2 times, right? The 2-month rule or 17%, whichever way is easier for you to think about it. So I would put that operating cash in a place, operating reserve in a place that can at least earn some interest. Why not? I mean, you can earn some money. So I think it depends on what your other balances are.
Thank you.
And I don't know which building you're at, but if you want to discuss that with me further, you've mentioned a couple of things that can be some complicated things and how to read your balance sheet and understand those things. I'm happy to get on the phone with you and spend 15 or 20 minutes and kind of just show you on the balance sheet where these things are and make you feel comfortable.
Thanks, Sam.
All right. Any other last minute questions? I'm seeing a lot of people are signing off. Sam, people have had very nice things to say in the chat about how helpful this has been. So I wanted you to know that.
Okay, great.
So if there are no more questions, I will thank everyone again for coming. And we will, as soon as Zoom finishes processing this recording, I will get this over to our graphics team so they can get this uploaded and we can get this pushed out so that everybody can send this to all of their board.
Carol, if you want to reach out to me, I'm at sam.leblanc at ejfrealestate.com. So
I know where to find you, Sam. Thank you.
All right. Thanks, everybody. Have a great rest of your day.
thank you, everybody, for taking the time. Appreciate it.